And we got a pretty good day today. We got the gorilla coming in a few minutes. We have drips today. So those who might be new to the Algo Factory YouTube channel, a couple things to understand. First of all, what we do is we help people become traders. We give them the nuts and bolts. We don't give investment advice of any kind. So we just kind of tell people what trading is, how to do it. Give me just 1 second. I just lost my brand new iPhone onto the floor, and I didn't want to roll over it with my chair. Anyway, those things are worth a lot of money. But at any rate, we help people become traders, and that's what we do. And eventually, you can take whatever algorithm you build, which really is just a trading method. It's not necessarily some computerized thing, and you can computerize it, and you can have that built, tested. You can tweak it, and then at some point, if you can make it successful, you can walk away and let it trade for you. So that's what we do. Quick QR code on the screen, and that'll allow you to come check us out and look online at what we do. And we'll talk a little bit more about that at the end of the show. But there's a QR code. You can zap that or just go to algofactory.tech. Website's right there. So another thing we do is we have the V the Gorilla, and he is, he and I put this together, and he'll come on here and do what we call drips. And so V the Gorilla does a lot of work internationally with some pretty big players. And what he also does is he talks to them, and they share and compare information about what's going on in the world of finance, in the world geopolitically. And here at Algo Factory, we are the beneficiaries of some or all of that information. So V doesn't share that on Rogue News along with all of the other, tens of thousands of people who listen to him, but he will talk about that here at Algo Factory. And then, of course, we have all that information sealed up so people cannot see it. So at any rate, that's happening, and it's happening later. The gorilla texted me a few minutes ago. He's gonna pop on shortly, but the drips will not happen until the private show, which happens in 26 minutes from now. So until then, I did have some questions. I think they're from Jay and Trev over on the Live Lab. Let me just tell them at Jay, at Trev will handle during the beginner session. Okay, so let them know. We're going to talk about that right now. We did cover what's going to happen in the news. Okay, so on Friday. So if you go over Friday's show, it's there's the beginner live lab, and good 5-10 minutes of that was covering what's going to happen in the news this week. And I use forexfactory.com. There are different solutions you can use for that. I've heard people say, oh, this solution's better, that solution's better. Maybe it is, maybe it's not. I know that Forex Factory has been good for me over the years. If you're using TradingView, you can actually look at a lot of this news, if not more of it, and it's actually populated on your chart screen. And we use, I use tradingview.com for my charting solution. That's not necessary, but that's what I know how to use. That's what I know how to use to backtest. It, as far as I'm concerned, is a bit more advanced than some of the other solutions out there, although I'm sure some of the other solutions have advantages over TradingView. I'm sure nothing is, all better, all worse, but I like TradingView. So all that said, here, Monday, there's really not a lot going on in the news as far as, events that might affect the market. Very quiet day. Tomorrow's another story. And like I said, we went over the whole week on Friday, so go check that out. But understand that tomorrow, especially after 10 a.m. EST, we start to get a lot of news that's going to throw the British pound and the dollar. Hold on a minute. That timing was incorrect. Let's fix this. It thinks I'm in Belgrade. Not sure why that is. Let's do -6. Okay. We'll fix those times really quick. Okay, so right after the beginning, it makes a lot more sense. After the beginning of the European session overnight, you're going to have a lot of information. Europe, Australia, a lot of manufacturing data coming out, even for the US. And then that'll, it will charge the trading session. And the last bit of data comes out just after trading opens. 9:45 EST is when the US data comes out. So once that data is digested by the market, might be some good times to trade, but overnight in the European session, it's going to be landmines. It's just going to be, a number of data releases throughout the session. So that's going to be tricky. All right. So let's get into the questions asked by Trev and, and Jay. So we're going to confront, now I have done some classes talking about spreads. If you go back through the clips, you'll find spreads. I think I talked about it 2 or 3 times. So, I have covered the spread. So if you want to know what a spread really is technically, go ahead and take a look at those clips. I don't want to waste too much time. Not waste, but I don't want to kind of cover ground that I've already covered 2 or 3 times on this show. You can just go back through the beginner. It's called clips anyway. So, I take clips usually from these beginner live labs, and I condense the data. Also, you can just simply look up what is the spread in trading. They'll tell you a lot of information. You can look it up on YouTube. You can look it up on just, whatever, Investopedia. Either way, the spread is going to be different for different assets, and certain assets have greater spreads than others. And one of the issues with a spread is that you're going to pay larger fees even if you enter at limit. So, entering at limit, that's also another class you can look up in the, in the clips. You can always look up clips, limit versus market. That's going to be in there. And when you enter at limit, you're controlling the price, right? So if you enter at spread, you're at the mercy of the buyers and the sellers. And so you're going to end up paying a bit more because you're not controlling the price. You're actually purchasing based on somebody else's price. So in this particular case, or in any case really, a limit order is going to be more profitable, or it's going to be less costly if you want to kind of look at it from that point of view. And I think either way, with some brokers, it depends on your broker. You might pay half the spread, whether you're limit or market entry. And that can also be costly. It just really depends on your broker and how they charge. And you're going to have assets that are going to have a lot more spread, right? So now each broker is going to tell you what their commissions are. And also another thing besides spread, you're going to have assets that have less leverage available if you're trading with leverage. And of course, anytime you're trading with Forex, you're trading with leverage. A lot of times with cryptocurrency, that leverage is going to be made available to you, but you have to look at your jurisdiction and kind of determine, okay, where am I allowed to trade? And you have to follow those rules. We talk about that a little bit deeper in the private lab, but of course we don't give any kind of legal advice or anything like that. You have to consult your attorney, consult your CPA, all that stuff for any actual licensure type advice. We don't give that. But what I will say is that the larger your exchange, the tighter the spread tends to be, but it's not always the case. I know I personally use, this is not like a recommendation necessarily, but I use Oanda, which is a US regulated exchange for Forex. So it's just kind of a safer place. It's got all the assurances you might have from something that's regulated. Assurances are just assurances. I mean, if something really bad happens, it doesn't mean you're going to get your money, but at least you have a better chance of it. So that said, one of the things you also have to look at is your leverage when it comes to those kind of pairs, right? Like Forex pairs will have, the pairs that have a lot more liquidity, like the 8 majors and things like that, they're going to offer you more leverage on that. And the more leverage you have, the less of your position, the less of your margin you have to put in. So what does that even mean? Let's talk briefly about that, because that is going to affect how things work. It's going to affect how many trades you could be in. Now, personally, I cannot track more than a few trades at a time. If I'm day trading, if I'm swing trading, it's a little bit different. But then again, if I'm swing trading, I don't have to enter as much of my own margin just by nature of the way that a higher time frame trade works, right? In a higher time frame trade, the price is going to move a lot farther, and you don't need to add as much of your own capital because it's just a much larger movement. So that being said, so let's quickly define a day trade is when you get into a trade in and out within like maybe a few hours, definitely within the same day, same trading session. A swing trade means you're leaving your trade on for a much longer time. maybe 2-3 days, maybe a week, whatever. And so a day trade, for example, let's look at this on a lower time frame so we can relate to it, right? So I'm going to look at this on a 30-minute time frame. That means each of these candles on this chart is going to be 30 minutes worth of price action. And let me clean up some of the stuff here. All right, so okay, that should be okay. So each of these candles is 30 minutes, right? So on a day trade, I might be in the trade, let's just say I didn't get into this because I was asleep. But let's just say I got into this trade like right here, and I wanted to bet, if you will, I wanted to trade risk that the price would go higher. And in this case, I would have been correct. Now, if I were to do that, and that's actually a trade I was in over the weekend. However, I had a feeling that in the low liquidity of the low liquidity of the market open on Sunday, we might get a nasty wick down. And sure enough, that is what happened, because I exited the trade before the close on Friday. So there was a nasty wick down right at midnight during the European Open, which is what I thought would happen. So at any rate, I'd still be in the trade. My stop loss is lower than that, but whatever. Anyway, the point here is that, of course, had I stayed in the trade, I would be ahead. That's neither here nor there. I didn't stay, and that's that. So in this case, this is like a day trade. I'm in the trade. Let's just say I entered at 1 a.m., right, my time. And then if I entered at 1 a.m. my time, it is now like 6:30. It's 5 hours later. So I could have gotten out of this trade within that same trading session, right? Now, that's a day trade. Now, if I were to try to stay in a trade longer than that, it would be a much larger trade, right? So if I'm zooming out here and I wanted to be in the trade for, like, say, a few days, maybe I'd enter on the 19th. And you look at this, right? And let's just say I went long right here. Now you're talking about a trade that might go like this. And I might still be in it, or I could have gotten out, say, here if I was, if I had done that. But there's a good chance it would look like this. If you see how much larger that trade is than this, right? Price is moving much, much farther. So in this case, I could enter a much smaller amount to get that same gain, right? I can enter, in this case, let me see, going from 48, 105, 48 to 106, so, and that's an entire, and this is, in Forex, this is a lot. It's well over a penny, if you will. This is a fraction of a penny in this case, like maybe a tenth or a fifth of a penny. So you're talking about something that's about 5 times as big. So I can use a fifth of the amount margin to accomplish the same kind of trade on a swing trade. So you can actually enter more trades if you're swing trading. And the reason is that, in Forex, you pretty much can't help it but use leverage. And so when you have leverage, there's an issue of margin. Let's say you have a $10,000 account. Okay. And let's say your margin requirement was, well, let's look up what the margin requirement is on EUR USD on my exchange, Oanda. So we're going to look at Oanda. A margin is the amount of money, of your money, that you have to actually enter the trade. The leverage is basically, it means that that's what you're borrowing to augment your trade. Okay. So anytime you're trading something that moves a fraction of a penny, you're going to have to like augment the trade. You're going to have going a fraction of a penny, put in $500, you're not going to make any money. So you borrow money to make that trade larger. That's just how this works. That's how Forex works. That's how a lot of other things work. So here is the EUR, where is it? USD right here highlighted. It's a little hard to see. Let me zoom in a bit. The lower your margin requirement is, the less money of your own that you have to put in. Okay. Whoa. And this is 2%, right? So in this, using the EUR USD, there's a lot of liquidity, right? Everybody trades it. So you only have to put in 2% of your money. If you want to trade the euro versus the Turkish lira, that you got to put in like 25% of it. If you want to trade a $10,000 position, you have to put in $2,500. If you want to trade a $10,000 position on the EUR USD, you put in $200, not $2,500. And we do have the gorilla in the house. What is up?
Hey, how do I sound?
All right. How you had a little? You sounded like you're jumping into the matrix there in a second. The microphone went crazy. Are you on that weird cordless one?
How about now?
I don't know. That was too quick of a sample.
The quick brown fox jumped over the sleeping dog.
Yeah, it sounds like you're still on the cordless one. It's not terrible. It's acceptable.
Right, hold on. All right.
Now you sound like you flushed an electronic toilet.
Sorry about that. How about now?
Oh, that's beautiful.
Okay, good.
He's trying to fool me. He's like, how about now? How about now? How about now? Like, no, you're still on the shitty one.
I'm back, baby.
Good. Yeah, you got. We're gonna take a break from our discussion real quick on margin requirements. Just to say hello to the gorilla. You were gone for 4 or 5 days.
Yeah.
This is your first broadcast since you've been traveling.
Yeah, absolutely, man. I took some respite, went back to NYC. Had a great time, dude. Had a great time. I was in the areas where I didn't see any migrants, homeless bums. Or
what you got against migrants, dog?
Because I'm racist. That's why.
You're a racist. You're a person of color.
I know that gives me the racist card. I'm only people of color are allowed to say racist things and not get in trouble. That's right.
No, actually, it's not the case anymore. You got to be all kinds of different checkboxes.
Yeah, but at least the racism card I could use. Like, I'm not like high up on the totem pole. Like, if I was,
you're not
non-binary, genderqueer, gender fluid, asexual, pansexual feeling.
You could put a cat in a blender in Fifth Avenue and drink it.
Yeah, and no, because I'm the most protected class in the world at that point.
That's right. So we're doing some talk about before we get kicked off of a particular whatever you call this thing, platform. We're talking about a margin requirements. We had some guys talking over the weekend. They were dealing with only being able to be in so many positions. And Jay, I know you get spreads, but other people don't. So we're just going to cover the whole thing. Actually, what I did recommend was people who don't understand spreads, go look through our clips. We have like 2 or 3 shows doing the explanation on spreads. But the more liquidity your pair has, the lower your margin requirements. So for example, with the Euro, EUR USD we're looking at on the screen there, you have a 2% margin requirement, which means for a $10,000 position, right, for that big of a trade, you only have to put in $200 of margin. Now, if you want to trade the Turkish lira, which has very little liquidity and a massive spread, not that the spread is relevant to your, necessarily relevant to your margin requirement, but you have to put in $2,500 to have a $10,000 position. So it's 25%. And so that might actually be related to the spread. That's one thing I honestly might be unclear with, but there is a definite correlation between thick, deep spread, wide spread, and margin requirement. And that is, I don't know if it is directly the reason, but that's for the same reason. It all comes down to liquidity. So, correlation is probably causation at this point. Like the British pound versus the Aussie dollar, pretty commonly traded, 5% margin requirement. So if you're trying to go out there and trade exotics, which exotics are going to be like your Turkish lira, Japanese yen, or your, you're trading like the Euro versus the Danish, I think that's the Danish krona. I'm not sure. TKK, I forget what that is. If you go into these currencies that not a lot of people trade, you're going to have to pay more. Hong Kong dollar versus Japanese yen, you got to put down 10%, right? And ON is actually pretty good when as compared to other brokers on that. So, South African rand versus the dollar at 7%. That's quite a bit higher. That's that's about 3 times higher than for the euro. So when you have to put down margin, we'll go back to our chart here so I can illustrate this and illustrate why you can only be in so many trades at a time. The reason is that you have a $10,000 account, right? So you want to be in 1 euro position. So let's just say you want to have a, let's see here. You want to put down, let's just say your stop loss has you such that you only want to lose 2%. So it's a $200 loss. That means you have to have like a, I don't know. Let's do a mock trade. No, I don't want to do mock trade. Shoot. Yeah, I'll open up like a. Let's see if we can try to make this. What do you call it? Simulation as real as possible. We'll connect to paper trading really quick. All right, so this was a $100,000 account. I took like a test trade to show everybody what was going on a few weeks ago, and it made 5%, which is beautiful. So now we're gonna say that we have a $100,000 account, just because that's what this is on our example. So that's our account, and the most that I'm gonna trade is 2% on this, which is $2,000. That means that I'm gonna risk $2,000. That means that 2,000 is to my stop loss. And again, this is getting in a little bit past the beginner session, but I do, in order to kind of explain this properly, I do have to show how this works. So, if you're a beginner, it's going to go a little beyond the beginner knowledge, but it's going to hopefully be able to illustrate this for you. And so that being the case, let's see here. Let me see, you have $2,000 risk. I'm going to go long. Okay, let's actually simulate this trade, this larger trade. Well, let's keep that on here. We'll do both. Okay, so for this larger trade, let's say I've got, a realistic stop on here for most people. We're trying to do an accurate comparison here, right? So I need to kind of size everything to be like that. Okay, so we would be entering at 105.476. So limit at 105.476. Stop loss at 1.05048, and take profit at 1.06565. Okay, so in this case, I want to only risk $200, right? That's $2,000, I should say, because this is a $100,000 account. That means that if you look here, it's a profit and loss as percentage of the account balance. So I'm just below. I can do a little bit bigger because I got $105,000. So let me just do 2%. 2% right here. That's actually the simplest way. And that way, if I win, I make 4.5%. If I lose 2%. So in this case, where's my margin? It should be telling me what my margin is on this. Why is it not telling me? That's weird. Price, units, risk, percent risk. Well, at any rate, the best, an easy way to look at it is the size of the trade. 467,000 quote unquote units, right? So you can only take so many trades because I have to put in 2%, not 2% related to my account, but 2% of the actual trade size. So, man, okay, so what is the position size here? That's the thing about Oanda. They don't freaking give you the position size, or if they do, this happens. No, I don't want to buy it. Let's see if I hit the buy button, if it tells me. Well, I bought it. I'm not even supposed to be in this trade. The position size is going to be relative to making this kind of money. So if you look at the position size of this trade, it's based here on these quote unquote units, right? Now this smaller trade, okay, we're just gonna have to pretend it's units right now. I'm kind of miffed that it's not giving me the data I want. Maybe it will up down here. Orders, positions. Okay, so we're not in an open position, right? Profit and loss, orders. Take profit, inactive. Here's our working order. Okay, so it's not giving us the position size, unfortunately, but it translates to unit size. So this is like a 470,000 quote unquote units, whatever that means. So you'll find that this position, risking that same amount, risking $2,000 on this smaller trade up here that we're going to do like a limit order on, is going to be a much, I think it's going to be, well, let's see what the number is. Let's just go ahead and enter it, right? So we have an entry at 105,788. We're going to have to jump over to private here pretty soon. I'll try to get this done. So 105,789, actually. 105,789. Okay. Stop loss at 105,678. Take profit at 106,171. Okay. And I'm going to go 2% again. Well, that's remarkable. Yeah, okay, that actually makes complete sense. All right, so in this case, 2% of my account is always going to be these units, right? But here's the trick. Here is the trick. It's the same amount of position size. It's got to be, right? Because I'm doing 2% of my account. See the same amount of units. But those same amount of units are going to get eaten up much more quickly. Well, let's use our actual tool here. We're going to go a little bit over on the private on the public session here. This is answering a private group question. So, so you see this measure from the top to the bottom. All right. That's 0.41% or 42.8 pips. Now on the second one, the smaller trade, that's going to be 11 pips. So you're looking at nearly 4 times the amount of distance to stop loss on this trade. Just about 4 times. It goes to like 43 pips on the long trade, on the bigger trade, and about 11 pips on the smaller trade. So the amount of money to do 2% of your account, the amount of money is obviously the same that you're entering, but you're going to eat it up 4 times as quick. Each one of these pips is going to be 4 times as big in profit or loss, because it's a smaller trade, but you're still trying to accomplish the same thing. And the problem with that is that in this case, if you could have a stop that looks like this, right? And a lot of times you can, this is a 3-to-1. This is like a 4-to-1. You can accomplish a much larger move with the same amount of money. You don't have to put in as big of a position on these trades here a lot of the time. For example, on this one, if I wanted to actually do a 2%, I'd have to change the stop loss to what it is, 1.05236. Okay. I could do half of the position size, right? So you'll notice that, this is probably what your stop loss is going to look like. Something like that. And why did it not change the position size? Okay. Well, it didn't, of course. But what it is that now 2% is eaten up much more quickly, but you get a 4-to-1. So you can accomplish a much larger gain by putting on this money. Or let's just say you wanted to have the same kind of gain. You could put on like 60-70% amount of the money on these swing trades. So the trick here is that the more trades you put on, the more of your margin you're going to eat up. It's a little convoluted session, I understand, because I was hoping it was going to give me my my margin amount. Other exchanges will give you your actual margin data, but we have to translate that to these units, which unfortunately, you know what? If I had been trading this on Oanda itself, perhaps they would have given it to me, but I don't even need this data. But I'm just trying to demonstrate how these smaller trades is going to eat up a lot more of your margin, because you have to put on a larger amount. You're going to, each one of your quote unquote, your pips is going to take a lot more quote unquote units, if you will. It's going to take up a lot more money. So you can have quite a few more of these swing trades on than you can have these day trades. But either way, your margin is going to get eaten up, because your exchange is going to have margin requirements. You're going to have to maintain at least, like, it depends on your exchange. It might be 10%, it might be 20% of your margin. I forget what OAND is because I usually only run, I mean, unless I'm doing my, if I'm going to run my robo trades, then I don't put a lot of money on those because, it might be like, 10 and 20 at a time. So I make them smaller. But on my like regular manual trading, I'm risking 2% usually. It depends on the day trades. I might risk a little bit less, but the swing trades definitely 2%. And so I make sure that I stay within the margin requirements because you can only run so many trades at a time. And if you're manually trading, if you can track more than 2, 3, 4 day trades at a time, then you are a better trader than I, because I can't track and manage more than, say 2, 3, 4 day trades at a time. Because you're in and out of those trades in like an hour, 2, 3, 4, 5 hours, sometimes quicker, sometimes under an hour, if you're really scalping. But if you're, doing like a swing trade, you could probably manage a few more of those, and chances are you don't have to put as much money on those because you can. A lot of times, if you have a certain kind of algo, your stop losses can be tighter. So, but at some point, the exchange is going to tell you, "I'm sorry, you can't trade any more than this. You have too much margin." Now, if you're trading all euro, right, then you're going to have a 2% margin requirement. So you can put a lot of euro trades on. But if you want to start trading exotics, you're going to be putting 25% of your money on that position. And it's all going to depend on your position size. So that's another reason I stick to the liquid ones, because, you're just going to have the opportunity to put on more trades. If I were just to trade the Turkish lira and try to make it profitable, I could have like that trade and maybe one other, and that's it. But I could put on 4 or 5 trades if I want to, trading the euro, trading the Japanese yen. And besides, who the hell wants to trade exotics? If they're not liquid, they move slow, the spread is massive. A lot of times the fees that you're paying are going to be half the spread on a lot of these exchanges. So if you have a 20, 30 point spread or bigger, then yeah, you're going to lose. Like if you put on like $1,000 trade, you're going to lose like 10, 20% of your trade just getting in. It's insane. So yeah, the wide spreads are going to be pretty harmful. I know Jay was talking about cryptos. You're going to have to, go look at your exchange and see what the calculation is for fees. I know there's an exchange that I like to use that we talk about in the private session that they, like, for gold, they don't give you any fees. For whatever reason, they just don't charge you commissions on trading gold. I don't know what it is. Maybe because most people lose money. Who knows? But with crypto, like with Bitcoin, oh my gosh, yeah, for a full Bitcoin position size, you're spending a lot of money just to go on that. So if we want to, we can continue this discussion in the private, though. So we've got the gorilla here. We got a hello from Mark Zhang and Lisa Gray. And, not exactly a beginner session, but it's a question that kind of should give beginners like a place to start looking. You can do a little research. What is margin requirement? What is the spread? Because this was more, trying to answer a question coming from just a bit more advanced of a trader. But again, you know what? The way that I personally learn when I get into something is if I don't understand something, if it's a concept that is beyond me, but I really want to know about it, I'm like, man, I want to skip to 6th grade. And I'll just go look that up. I'll usually find that starting there doesn't work. But then at least by the time I get back there, by the time I get back there, then I'm like, oh yeah, I remember this, and I just understand it a lot better. But a couple of notes from the guys before we move on. Trevor says 100 back tests on silver, nice correlation, could only place 0.4% of trading account. Yeah, okay, so yeah, for whatever reason on silver on Trev's exchange, he has a very small margin that he's allowed. The margin requirement is probably really high on silver because he can only put 0.4% of his account on that trade. Jay says, because Jay trades out of the US, he says his Binance margin fees on futures went up 80% of the profit over 3 or 4 hour trade, but kept only 20%. Says he's going to go to another exchange or two. So yeah, Trev says, yeah, okay, good. Trev's good to go. Jay's good to go. That's, again, not exactly a beginner session, but it is what it is. V, can you kick us over to the private lab so we can move on?
Yeah, absolutely. Listen, guys, here's the deal. Don't sit on the sidelines watching the profits and the money go by. Be a part of it, because Algo Factory is something that you can utilize as probably one of the most important things you can learn and where we not only teach you how to trade, but we teach you how to build the algorithms that do the trading for you 24 hours a day, 7 days a week, depending on your market. So listen, don't sit on the sidelines any longer. Join us. And with that being said, Cal,